Hello everyone, welcome to SPAC Chat. I'm Karen Snow, head of East Coast listings here at Nasdaq, and it's my great pleasure to be speaking with Dr. Seung Liu, Chairman and CEO of Mountain Crest. Mountain Crest is renowned for its successful business combination with PLBY Group. In addition, they have successfully completed a second business combination with Better Therapeutics, an innovative prescription digital therapeutic platform, and have 3 actively traded SPACs on Nasdaq. Seung, congratulations and welcome.
Thank you, Karen. It's great to be here with you.
Fantastic. Well, why don't we start off by having you tell us a little bit about your background and how Mountain Crest came together?
Sure. I actually started out in academia. I was teaching at Washington University in St. Louis while completing my doctorate there. Then I joined JP Morgan with a focus primarily on real estate financing. After that, I got more involved into the development side of things at a boutique real estate shop, essentially doing private equity real estate transactions, or PERE as people call it. I then carried on that private equity mentality and methodology into a public company setting. And it was around the similar time of 2019 Q4, so 2 years ago, that I started our first SPAC, which was before the space got popular, actually. And further to that private equity notion, we consider to some extent SPAC merger as publicly traded private equity transactions, given the similarities structurally, financially, and operationally. And like you mentioned, we've completed 2 business combinations already, and are working on more with our additional vehicles.
That's fantastic. So what is it that you think makes Mountain Crest different?
Absolutely. I think we have really distinguished ourselves among small SPACs in particular, or vehicles that are less than 75 million in offering size, as we like to define it. Number one is, of course, our track record. Our first SPAC merger, and probably our most well-known so far, was with Playboy. And it took us only 8 months from our SPAC IPO to completing the D-SPAC on that deal, which is one of the most efficient transactions on the street, if not the most at that time, to our knowledge. For our Mountain Crest 2, we went public this January and completed our business combination with Better Therapeutics in October, so about 9 months this time. Hence, efficiency is also one of our attributes, if you will. Now, it doesn't mean we will trade off quality target identification with efficient deal execution, though. And we definitely are not making a goal here at Mountain Crest in terms of beating our own record. And if we need to take time on certain processes like due diligence and target selection, we take the time. However, what's behind that efficiency is really our energy. I'm of Asian origin, obviously, and so are some of my team. And most of us do maintain good connectivity with that region as well. But that actually has made us develop this habit of working as deals need us, whether it's daylight, our time here, or that overseas. And speaking of size, as I'm analytical by training, I look at the data a lot. Now, despite the sheer volume of SPACs out there, the small subsector is in fact very few in number. So unlike the larger size SPACs where you probably heard of something even like SPAC offs, as people competed fiercely for a few select targets, we are actually outnumbered by quality target companies. And adding on top of that is our no warrant structure, which we are a pioneer of. And that structure is economically beneficial for the target companies by being even less dilutive, especially in conjunction with our small sizing. Now, this sort of structural design probably reflects another almost philosophy of ours, which is to think from other people's perspective. Of course, we have our fiduciary responsibility to our SPAC investors, and we have indeed delivered pretty good results for them. But we also want to be structurally friendly to our targets. And if that means somewhat less economics for ourselves as a sponsor, we are okay. We have relatively small number of founder shares, and not only do we not have public warrants, but we don't have private warrants either. And by giving up that potentially lucrative convex payoffs from the warrants, we further reduce dilution to our targets.
Yeah, that's very important, especially in today's market. So let's focus in on the targets and talk a little bit about how you evaluate the targets. What is it exactly that you're looking for?
Sure. We look for a defensible and disruptive niche, either through the technology or for competitive advantages operationally. we look for substantial organic growth as well as add-on acquisition opportunities, where Playboy is actually pretty illustrative of this category with its core licensing business that is coupled with further acquisitions along the way. And if you think about it, given our small sizing, which means the size of a target company of ours is also likely on the smaller side, it's actually a pretty good setup for a roll-up strategy, especially when post-merger, the company can use the public equity as potential acquisitive currency as well. And to round it up, additionally, we look for sector leaders in more fragmented industries with great growth trajectories, as well as, of course, management themselves in terms of experience suitable for public markets.
And what do you say to targets that are dual tracking? Because I think most of them are. How would you frame the SPAC alternative versus the IPO, for example?
Yeah, the SPAC route is faster since part of the process of going public is done on the front end. And the deal certainty from this approach is also higher since a traditional IPO is through this iterative price discovery mechanism where pricing range and offering size are subject to change. And sometimes that change can lead to breakdown of the process. In comparison, for SPAC transactions, your valuation is more known upfront. And given the prevalence of PIPEs these days, that financing is effectively front-loaded as well, which is further certainty enhancing. The third advantage of SPACs is probably the use of forward projections, which is helpful, especially for more growth-oriented companies. Now, two caveats though. First is that faster doesn't mean easier. From our due diligence to regulatory disclosure, targets should expect to thoroughly address any items along the way throughout the process. Also, the fact that one is able to use forward projections doesn't mean one can abuse it. In fact, we tend to haircut projected financials presented to us by targets to apply conservatism.
Yeah, that's great. It's great to hear, actually, as well. So if you're a target looking at sponsors, and you kind of mentioned these SPAC offs that are happening, what are the key factors that you think a target should think about in terms of their evaluation of the right sponsor?
Well, the first is definitely track record. Having done it and having done it well means there is institutional knowledge, process know-how, and deal experience, all of which are conducive for another successful transaction. Second would be the willingness to be a true partner, right? Where they share your vision as the entrepreneur and with the management. Beyond what the various metrics indicate, to some extent, it's actually like real estate. You haven't necessarily completed building out the property, no sophisticated decoration or ornament just yet, but you will likely serve the deal well if your SPAC partner can visualize it without necessarily a full rendering from you. Third, in my view, is traction. It will help if they have more or less built their own brand and generated some following from institutions, perhaps as well as retail. So when you embark on that de-SPAC process, and probably even more so post-merger, you can potentially gain more attention from the general public. After all, you are going public, so try to have someone who can make your hello world statement louder and stronger.
So I have to ask, given where we are in the SPAC market, tell me how you're thinking about it. What are your thoughts? Are we in a bubble? How are you thinking about this?
Absolutely. There are indeed a lot of SPACs out there, like 500 plus or something. I'm a financial economics by training, and while the market may not always be efficient, it does have the tendency to become efficient and get to that equilibrium. Now, what that means is perhaps twofold. On the one hand, this huge increase in popularity of SPACs probably is due to pent-up demand to start off with. Looking again at the data and thinking again about private equity as an example, US private equity funds alone raised nearly $2 trillion between 2006 and 2016. So that capital likely had been put into good use in a great number of private equity portfolio companies. And if you think about sort of the midpoint of that 10-year period, at least some of the portfolios in that vintage have probably started looking for exits, like last year, this year, next year. In fact, even Playboy is probably a good example as it went private back in 2011 with involvement from private equity, and now they are public again 10 years later. However, on the other hand, it's also possible during this market's process of meeting that demand, you overshoot, drawing in people that may not be really fit for it as well. Then some market adjustment will likely need to take place, during which we can probably expect significant variation in deal outcomes.
I think that's very well put, actually. So before we sign off, any final words of wisdom?
Sure, and probably also as a further observation of the marketplace, this segmentation by size of SPACs, which we certainly have put our own focus on, will probably play a more useful role as we take note of this potential increase in the variation of target sizes as well. Some of that is driven by innovation in certain industries, such as biotech, especially given COVID. It seems people have put more focus onto the healthcare sector. And I do believe smaller but innovative and high growth companies should indeed have meaningful representation in the public markets. And I actually think Nasdaq has been at the forefront of this and helping the whole ecosystem develop as well. And for this particular segment that we are in, modestly, I think Mountain Crest is pretty well positioned. Given the market environment, it is definitely important that you know what you're doing, and we do. And this tendency for high quality targets to really connect with high quality sponsors that we have noticed ourselves is also encouraging to us when we approach deal sourcing. We look forward to growing our franchise, meanwhile witnessing the excitement of the ever-evolving SPAC industry.
That's great. Seeing, thank you so much for your time. And on behalf of everyone at Nasdaq, we wish you continued success. And that's it for SPAC Chat. See you next time.